Have you ever wondered what the Dow Jones, S&P 500, and NASDAQ are? Well, you're not alone. Every day, millions of people across the globe hear about these indices in the news, see them on financial websites, and follow their movements. But what exactly are these indices, and why are they so important? Let's start with a brief overview. Stock market indices are like measuring sticks for the financial markets. They track the performance of a specific group of stocks, providing a snapshot of the overall market's health and direction. Think of them like the thermometer of the stock market, taking the temperature of financial health. Now, onto the big three. The Dow Jones Industrial Average, S&P 500, and the NASDAQ are three of the most widely followed and discussed indices in the world. They represent different segments of the US stock market, and each has its unique characteristics and companies. The Dow Jones is like the granddaddy of them all, tracking the 30 largest and most influential companies in the US. The S&P 500, on the other hand, is broader, encompassing 500 of the largest US companies across various industries. And then there's the NASDAQ, a tech-heavy index that showcases the performance of more than 3,000 companies, many of which are in the technology sector. In this video, we'll take a deep dive into each of these indices, explaining what they are, how they work, and what role they play in your investment decisions. We'll also talk about how you can invest in these indices and the advantages of doing so. Plus, we'll tackle the often misunderstood topic of market fluctuations, helping you understand why markets move the way they do. So, whether you're a seasoned investor or just getting your feet wet, there's something for everyone in this comprehensive guide. Stay tuned as we delve into the first of these three, the Dow Jones Industrial Average. The Dow Jones Industrial Average sounds complex, doesn't it? Fear not, it's simpler than you think. So, let's dive right in. The Dow Jones Industrial Average, often just called the Dow, is one of the oldest and most watched stock indices in the world. Named after Charles Dow, one of the founders of Wall Street Journal, and his business partner Edward Jones, it was first calculated in 1896. But what exactly is it? Well, the Dow is essentially a stock market index. It tracks 30 large, publicly owned companies based in the United States. You've probably heard of many of them, including household names like Apple, Coca-Cola, and Disney. Now, you may be wondering why it's so significant. The Dow serves as a barometer for the overall US economy. When you hear news reports saying the market is up or the market is down, they're often referring to the Dow. It's a way of summarizing the performance of many different stocks into one easily digestible number. That said, it's not without its critics. Some argue that the Dow isn't the most accurate representation of the market because it only includes a small number of companies. Others say its method of calculation, which is price-weighted rather than market cap-weighted, can skew its representation. However, despite these criticisms, the Dow continues to be a key indicator of market trends. It's used by investors worldwide to make decisions about buying and selling stocks. But remember, while the Dow can give you a snapshot of the market, it's not the whole picture. It's just one of many tools that investors can use to understand the stock market. And there you have it. That's the Dow Jones Industrial Average. It's a crucial piece of the puzzle for anyone looking to comprehend the world of investing. So that's the Dow Jones in a nutshell. Next, we'll look into the S&P 500. Moving on from the Dow, we now come to the S&P 500. This is another major player in the world of stock market indices. But what exactly is the S&P 500? In essence, it's a stock market index that measures the performance of the 500 largest companies listed on stock exchanges in the United States. The S&P in S&P 500 stands for Standard & Poor's, the company that created this index. The 500 inches refers to the number of companies included. It's a broad representation of the overall US stock market and is considered one of the best single gauges of large-cap US equities. And who are some of the companies on this list? We're talking about big names in various industries. Companies like Apple, Microsoft, Amazon, and Facebook. Giants from the tech sector. You'll also find Johnson & Johnson and Procter & Gamble from the healthcare and consumer goods sectors, respectively. These are just a few examples that illustrate the diversity within the S&P 500. Now, why is the S&P 500 important? It's a key indicator of the health of the US economy. Because it represents such a large portion of the market, it gives a reliable snapshot of how well, or not so well, the US business sector is doing. It's also very influential in the financial world. When the S&P 500 is up, it generally means the market is doing well. When it's down, it's a sign that things might be a bit rocky. The S&P 500 also plays a big role in personal investing. Many mutual funds and exchange-traded funds, ETFs, are based on the S&P 500. This means that when you invest in one of these funds, you're essentially buying a small piece of each of those 500 companies. In conclusion, the S&P 500 is more than just a list of companies. It's a powerful tool for understanding the U.S. economy and making informed investment decisions. With the S&P 500 understood, we're ready to tackle our last index, the Nasdaq. Last but not least, let's explore the world of the Nasdaq. This is a global electronic marketplace for buying and selling securities. It's a hub of activity where stocks, bonds, and other financial instruments change hands every single day. Now, the Nasdaq is a bit different from other indices. It's known for its heavy emphasis on technology companies, making it a hotbed for tech titans and promising startups. Some of the biggest names in the industry call it home. Think about companies like Apple, Amazon, Microsoft, and Google's parent company, Alphabet. These are just a few of the tech powerhouses listed on the Nasdaq. But tech isn't the only game in town. The Nasdaq is also home to major players from other sectors. From retail giants like Costco to biotech firms like Biogen, the Nasdaq's reach extends far and wide. So what makes the Nasdaq so significant? Well, its emphasis on tech means it's often seen as a barometer of how the tech sector is doing. When tech stocks rise, the Nasdaq tends to rise too. When they fall, the Nasdaq often follows suit. It's like a mirror reflecting the ebb and flow of the tech world. But the Nasdaq is more than just a reflection of the tech sector. It's also a key player in the global financial system. It's one of the largest and most influential stock exchanges in the world, with thousands of companies listed on it. This makes it a major hub of economic activity, influencing investment decisions and financial strategies worldwide. Navigating the Nasdaq, like any stock exchange, requires careful consideration. It's a dynamic, ever-changing landscape where fortunes can be made or lost in the blink of an eye. It's a place where bold ideas meet financial realities, where dreams of growth and prosperity are put to the test every single day. That wraps up our tour of the Nasdaq. But how do you go about investing in these indices? You've gotten to know the indices, but how can you invest in them? Well, investing in these indices, Dow Jones, S&P 500, and Nasdaq, is simpler than it might seem. The easiest way to do this is through index funds or exchange-traded funds, ETFs. These are essentially baskets of stocks that mimic the composition of an index. So when you buy shares in an ETF, you're essentially buying a slice of the entire index. Let's consider the SPDR S&P 500 ETF, for example. This fund aims to track the performance of the S&P 500. So when you invest in this ETF, you're investing in all 500 companies listed on the S&P 500. This means you're buying a tiny piece of each of these companies, from tech giants like Apple and Microsoft to consumer staples like Procter & Gamble and Coca-Cola. But why would you want to do this? Well, there are several advantages to investing in indices. First, it provides diversification, reducing the risk associated with investing in single stocks. Instead of putting all your eggs in one basket, you're spreading your investment across a wide range of companies. Second, it's cost-effective. Investing in an ETF can be cheaper than buying individual shares of each company in an index. Plus, index funds and ETFs often have lower expense ratios than actively managed funds, which means more of your money goes towards your investment, not fees. Third, it's a passive investment strategy. You're not trying to beat the market. Instead, you're aiming to match its performance. This can be a less stressful and time-consuming way to invest. Lastly, investing in indices allows you to benefit from the overall growth of the market. Over time, despite short-term fluctuations, the stock market has historically trended upward, which can result in long-term gains for index investors. However, investing in indices can be a wise move, but remember, the market is always fluctuating. It's important to have a clear understanding of your financial goals and risk tolerance before diving into index investing. And as always, it's wise to consult with a financial advisor to ensure you're making the best decisions for your unique situation. The stock market is a sea of constant change. Let's understand why. Market fluctuations, or the ebb and flow of stock prices, are a natural part of the investing world. Like the waves of the sea, they rise and fall, influenced by a myriad of factors. These can include economic indicators, corporate earnings reports, geopolitical events, or even changes in investor sentiment. Imagine a seesaw, constantly moving up and down. That's what market fluctuations are like. They're the ongoing shifts in stock prices, swinging between highs and lows. Why does this happen, you might ask? Well, it's all about supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, when more shares are for sale than there are buyers, the price goes down. This dynamic interaction between buyers and sellers is what creates the market fluctuation we see. But what about economic indicators? How do they play into this? Let's take unemployment rates as an example. If unemployment rates are high, companies might see their profits shrink, as fewer people have disposable income to spend. This could lead to a decrease in the company's stock price. On the other hand, when unemployment rates are low, companies might see an increase in profits and a corresponding rise in their stock prices. Market fluctuations also impact our indices. If the majority of the companies within an index see their stock prices fall, the overall index will drop. Conversely, if most companies within an index experience a price increase, the overall index will rise. Understanding market fluctuations can help you make informed investment decisions. For instance, a drop in stock prices might be seen as a buying opportunity, while a rise in stock prices might signal a good time to sell. Remember, investing is not about predicting the exact peaks and valleys, but about riding the waves. It's about understanding the rhythm of the market and making informed decisions based on that understanding. Fluctuations might seem scary, but they're a natural part of the stock market. Embrace them, understand them, and let them guide your investment journey. We've covered a lot today, so let's take a moment to recap. We began by introducing the concept of stock market indices. Indices, in essence, are a statistical measure of the changes in a portfolio of stocks representing a portion of the overall market. They provide a snapshot of the market's overall health and direction. Next, we delved into the Dow Jones Industrial Average, one of the oldest and most watched indices in the world. The Dow Jones consists of 30 blue-chip stocks, carefully selected to represent a wide array of sectors within the American economy. Companies like Apple, Microsoft, and Coca-Cola are part of this illustrious list, exemplifying the diversity and strength of the companies that make up the Dow Jones. We then unpacked the S&P 500, another major index that provides a broader view of the market. Unlike the Dow, the S&P 500 includes 500 of the largest companies listed on the American stock exchanges. This makes the S&P 500 a more comprehensive indicator of the market's health and a popular choice for investors seeking diversified exposure to the U.S. equities market. Afterwards, we navigated the Nasdaq, an index known for its heavy concentration of tech stocks. This index includes giants like Amazon, Google, and Facebook, making it a hub for those looking to invest in the tech industry. However, the Nasdaq also includes companies from other sectors, offering a well-rounded investment option. We then explored how to invest in these indices. Investing in indices can be done through index funds or exchange-traded funds, which track the performance of the index. This way, instead of investing in individual stocks, you're investing in a broad slice of the market, providing you with a level of diversification that can help manage risk. Next, we addressed market fluctuations. We highlighted that markets are dynamic and constantly changing due to a variety of factors like economic data, geopolitical events, and investor sentiment. Understanding these factors can help you make informed decisions and manage your investment risk effectively. In conclusion, understanding these indices and how they work is an essential step for anyone looking to navigate the world of investing. They provide a wealth of information about the market's health, the performance of key sectors, and the broader economic landscape. By understanding these indices, you can make more informed decisions about where to put your money and how to manage your investment risk. Investing in these indices can provide a level of diversification and exposure to a broad range of companies and sectors. But remember, it's essential to continue learning and stay informed about market trends and changes. Remember, investing is a journey, not a destination. Keep learning, stay informed, and you'll navigate the financial markets with confidence.